What's going on, YouTube fam? This is the Wealth Investing Network. We do this for the win. You're getting a sneak peek into my stock portfolio and a sneak peek into my research on stocks. Today, we're talking about Chargepoint, and we're comparing them to a company that will be brand new to the stock market, Wallbox Chargers. It's being brought to us by Kensington Capital Acquisition, which is a blank check company, also known as a special purpose acquisition company or SPAC. The ticker symbol is KCAC, and as we know, blank check companies trade around $10. And once the merger is complete, if all goes to plan, the ticker symbol will change to WBX. But before we really get into the news, there's a couple things I have to ask you to do, and that's please hit that like button, turn it blue, drop a comment, subscribe if you are new, because these things all help the channel grow, and that helps me create better content for you. That's what I call a win-win, and we like that here at the Wealth Investing Network. Also, please let me remind you that I'm not a financial advisor, and this is not financial advice. If you're here to follow my journey, great, because these videos are for entertainment. Please do your own research. I'm just going to show you a little bit of my research and what I'm looking at with these stocks. So, Wallbox has announced their merger with Kensington Capital Acquisition Corp. 2. The first Kensington Capital SPAC that they brought merged with the battery company's QuantumScape. And they had a different ticker symbol at the time. They traded around $10. The merger was announced. And generally, when the price goes above $10, it means that investors like the deal. And investors really like this deal. And a lot of the EV SPACs have been on fire, and EV companies in general. I think it's important to note TPGY. They're set to merge with EVbox Group. One of the reasons why it's important to mention them is because EVbox is one of the leaders in the European market. Wallbox is a Barcelona-based company, and they have a big presence in Europe, but they're also expanding their reach globally. They have home charging, business charging, public charging as well. They have software and an app that connects to it all. But so does EVbox Group and Chargepoint, all direct competitors in Europe. And EVbox Group and Chargepoint are also bringing in more revenue than Wallbox, and also stand to benefit from the growth of EVs. And I know it's confusing with the ticker symbols, and I think that could be part of the reason why this stock isn't moving that much. But SPACs also calmed down a lot around March, because traditional IPOs take a lot more time and money and resources. But for a private company, at the end of the day, you get to launch onto the public markets and you get access to more investors and more dollars to hopefully make your business better. But SPACs are a faster way. There's a little bit less scrutiny. Now the SEC, or Securities and Exchange Commission, is starting to bring a little bit more scrutiny to these mergers. And the number of SPAC IPOs decreased significantly in April. There was a lot of hype that's calming down now. And there was hype in the EV space in general. When I talk about hyped EV stocks, I've got to talk about BLNK charging. You can see they're up well over 1,000% just in the past year. But don't focus too much on the stock price. I like to focus on the market cap. And when we look at Yahoo Finance, they have a market cap of roughly $1.5 billion. Impressive revenue growth, but at the end of the day, their revenue in the last 12 months was $7 million. And so to pay a multiple like that on their revenue of only $7 million, that's when you get into the price to sales ratio, which we'll talk about a little bit more later. But just for now, you want this number to be as close to 1 as possible, because it's the market cap divided by their revenue. And for BLNK charging, you're paying a multiple of almost 200 times their sales. I mean, Tesla had a huge run up, but they're still only about 18 times sales. Sometimes electric vehicle stocks get completely divorced from fundamentals because there's a group of investors on Reddit, the Wall Street Bets crowd, that are targeting short sellers. Short sellers make money when stocks go down. They borrow and they bet against the company, wanting it to fail. But when it shows signs of strength, they're forced to get out of their position. To do so, they have to buy a bunch of shares. And it seems right now there's a war between the hedge funds and the Reddit traders, which is completely unsustainable. And so I just wanted to touch on that because people might bring up BLNK charging, but Chargepoint is clearly more of a leader in the space. In the United States, I mean, you see their map here. They're all over the place, and they have a significant presence in Europe. But you look at a company like BLNK and you don't really see a big presence. I want you to do your homework. Whatever city you're in, look up what's the most popular charging options near you. Maybe it's Wallbox. They have over 100,000 units sold and over 150,000 public charging stations connected. With public charging, they're focused on DC fast charging, which depending on your vehicle can get you about an 80% charge in 30 minutes, which isn't bad. Level 1 and level 2 charging take a lot longer, over an hour. A lot of people charge overnight or while they're running some errands, but it doesn't drain on your battery as much. And while I think fast charging is getting more and more popular, level 2 charging is still huge, and Chargepoint has about a 73% market share according to their investor presentation. Now, I think it's interesting that they don't include Tesla in this list, and that's perhaps because Tesla charging stations cater specifically to Teslas. But if these other EV charging companies started including Tesla on the list, it wouldn't make them look as good. So I know I'm kind of jumping all over the place here, but back to Wallbox. They have a lot of well-known partners. Their expected growth rate is impressive. And so let's get into their financials, because that's what I really like to talk about with stocks. They're expecting total revenue for their fiscal year 2021 to be about $79 million, which is impressive. But they're not a profitable company. Their gross profit is going to be about $31 million, and their operating expenses is more than double that. So they're bringing in huge losses. Even before debt, taxes, and things of that nature, their margin is negative 50%. That's not exactly what you want to see. And their investor presentation does not include a balance sheet. Maybe it's out there somewhere, but I appreciate that Chargepoint included a balance sheet, right? And so when Chargepoint merged, we can look at Yahoo Finance and see their current ratio, or their assets over liabilities, is fantastic. There's no worry here because they have over $600 million in cash with almost no debt in comparison. EVbox Group, or TPGY, also included a balance sheet, but I just don't see that with Wallbox. So that's an area of concern because I want to know if they're going to have debt after this deal merges. Right now, I only know that they're going to have about $330 million in cash, but how much of that will they have to use to pay down debt? Well, we don't know. Now, one thing that I definitely want to mention is that in the United States, the president, Joe Biden, is pushing a huge plan, multi-billion-dollar plan, to spur the adoption of electric vehicles, and he wants to build a national network of 500,000 charging stations. So this market can double and triple very quickly, and Chargepoint, as a leader in the space, especially in the United States, I think will benefit. Chargepoint has over $150 million in revenue, and pretty much anywhere you go in the United States, you'll find a Chargepoint charger. And I think their potential to expand creates a great opportunity, and that's made the stock very highly valued. So that does make it subject to a lot of volatility. And I talk about that in other videos. I'm not going to get too much into it here, but check the links in the description and in the cards if you want to catch up, because I'm trying to move quickly. And so I'm going to jump into my analysis now. Because Wallbox is not merged yet, these estimates are a little rougher. I have them in gray. So the first thing I want to look at is their market cap. I've noticed a lot of the articles that I'm seeing about Wallbox focus on the fact that in today's numbers, if they merge successfully, they'll have a very low market capitalization compared to other public companies. But remember, this market cap is at the $10 price. So let's just say the stock doubles, this is going to double as well. And so SPACs are kind of tricky. Next, usually I like to look at the PE ratio, or price to earnings ratio, but these companies are bringing in losses. They don't have earnings at this point in time, but we can look at their price to sales ratio. And you want this number generally to be as close to 1 as possible. The higher this is, the higher a multiple you're paying on the stock. So right now at these prices, investors are paying a multiple of over 40 for Chargepoint. And the multiple for Wallbox at $10 would be about 19, which matches up to Tesla. But here's an area of concern for me. Chargepoint's revenue growth is 24%, but their initial expected growth rates were much rosier. They were expected to pretty much double every year or 2 years. So when I look at Wallbox's growth and their expected growth, under what conditions is this growth sustainable? They expect their operating expenses to more than double. And if their operating expenses are $140 million for their fiscal year 2022, well, that's pretty much half their cash. So then at what point are they going to start taking on debt? And again, what debt do they already have? We don't have their balance sheet here. So generally, I'm impressed by Wallbox. They are an impressive company. However, I do think the EV hype, in terms of SPACs especially, is calming down. And they're not exactly the leader in their space like Chargepoint is. They're not in a battle with the hedge fund shorting them like BLNK is. They are trying to say they're at a reasonable market cap, but I'd be less impressed with their valuation in terms of price to sales if they're going to have to start taking on debt. Chargepoint as a debt-free company would look much more attractive. And then at the same time, Wallbox is saying that by 2025, they're going to be well on track to positive earnings. These projections just seem a little lofty to me. I'm not going to trade this stock based on what I think they're going to do in 2025. I do think they're at a relatively reasonable valuation for what they're doing now, but I'm going to give it some time. Maybe I'm wrong here. Maybe they could be one of the next meme stocks. Who knows? I do think there's a potential for all the EV stocks, but I'm going to stick with Chargepoint right now. I'm long Chargepoint. We're out of time today. Let me know what you think of some of these companies. Should I do a separate video on EVbox? Should I compare Wallbox and Chargepoint to any other companies? Comment below. Give me some feedback. Also, don't forget to hit the like button and subscribe, because it's a win-win, and we like that here at the Wealth Investing Network. Thank you so much for watching. I've got to go charge my batteries. See you in the next video.